5 things I wish I knew when I started investing. I believe most of us in investing, we have the same story, we go through the same journey, we make the same mistakes, and we learn them the hard way, which is why I love doing those videos and putting them in a learning playlist where I share mistakes I made in the market. So a lot of you guys can learn from my own mistakes instead of learning from your own and losing your money. The hard way is the way I did it. So I love sharing them here. I want to share 5 very important lessons that I learned, and I wish I knew them back when I started investing. I would have saved a lot of money. And if you do enjoy it, they don't get a lot of views. So all I'm asking is please press the like button and let me know what you think in the comments. The first one, which might be a controversial one, might surprise some of you, is that the PE is useless. So back when I started investing, and maybe some of you are the same, you go on Yahoo Finance and you see a company trading at 30 PE or 35 PE. Oh, that's overvalued. Would you skip the stock? 25 PE is too high. Would you skip it? 50 PE is too high. 100 PE is too high. All of it is too high. It's overvalued. Would you skip the stock? I used to do the same thing. But as you go along, you're going to learn that the PE is useless for 3 main reasons. The first reason is some companies, they have a high PE on purpose, you could say, because they reinvest in themselves. You could say companies like Amazon. This is the best examples I can come up with, because Amazon has $311 billion in gross profit. They spent $88 billion in research and development. So the bottom line net income, which is used to get the PE ratio, is around $59 billion. Now, Amazon has Amazon.com. It's going to be here forever, pretty much, most likely. They have Amazon Web Services. They have a logistics mode. Yet they're spending $88 billion in research and development to improve themselves, to come up with new products, and to remain competitive. Now, Amazon does not have to spend $88 billion. They can cut it by 50%, and trust me, Amazon would still be alive. So instead of spending $88 billion, let's say next year, they decided to spend $42 billion or $44 billion. In this case, net income would jump from $59 billion to around $100 billion. And the PE that's looking at 35 that looks overvalued, it could be maybe 22 to 25 PE. So is Amazon really overvalued in this case? Or should we really skip it just because the PE is high? So this is the biggest ones that I learned the hard way, is that you have to really look at where the money is going. If it's all going, let's say, into something that's essential, such as personnel and a lot of things within SG&A or cost of sales, then yeah, there's nothing you could do about it. But if it's going into research and development and the company can pull back on it anytime and it could boost net income, then maybe a high PE isn't such a bad idea, because the PE could be low pretty much any time. The second reason why the PE is useless is because some companies, you can't value them on a PE ratio. Like trying to value a REIT on a PE ratio is not going to work too well. You have to value them on a price to adjusted funds from operations per share. Companies like Brookfield, you have to value them on their own distributable earnings per share. Some companies have certain accounting measures. You have to kind of use their own metric, not because they're manipulating accounting, but because they have certain maybe one-time acquisition expenses that you have to adjust for and certain one-time expenses. So you have to adjust for them. So, and some companies, they have to be valued on a free cash flow yield. If they have a lot of assets, they have a lot of depreciation, you might have to use the free cash flow yield to get the most accurate metric. So you can't just skip any stock because the Yahoo Finance PE ratio looks high and then it just means that it's overvalued. It's not even close to that. And the third reason, if a company has a high PE ratio, let's say 35 PE, but it's growing earnings 30% and it can maintain it for 5 years, the PE is not really high. So it's, yes, the PE is high, but relative to what? Do they have high earnings growth? Is it sustainable? Do they have high margins? Do they have a wide moat? So skipping a company because the PE is high is a really bad mistake. And it's a beginner mistake, but you kind of learn it over time that it's not the best thing to do. Now, the second thing that I wish I knew when I started investing is that position sizing is more important than valuing stocks. And people go crazy whenever I tell them that, especially in the group, because valuations are very important. They're really, really important. But this is a very nice quote in investing. And it says it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. So most investors in general, they focus too much on, let's say, the thesis and let's say the company, and all those things are very important, but they worry about little things while they can take care of those little things or those risks by implementing the right position sizing. So sometimes I talk about growth companies. Let's say whenever I talked about Robinhood at $42, which is up 270% in 4 months, and I was getting a lot of concerns, high stock-based compensation, the company is not too profitable, listed, but you could clearly see the upside. The upside was huge. Same thing with SoFi, which has doubled. The upside was huge. So if the upside is so high and there's some risk, but they're not too crazy, why not make it a small position? In this way, if you're right, you make a lot of money, but if you're wrong, you don't lose too much because it's not a large position. You have an asymmetrical payoff. So in this case, yes, valuations are important. I'm not saying don't value stocks, but I'm saying most investors, they don't think about position sizing. It's something that's big for me. It's something that I teach in my group. But position sizing is important. And I tend to risk more money into stocks, let's say like Berkshire Hathaway, and you could say the big seven and big companies. And I risk a smaller percentage in a lot of the growth stocks that are riskier. I don't avoid them because they're riskier. I just risk a smaller amount because the upside is so high that I don't need to put in a lot of money if I'm right. My upside is huge, but my downside is limited because I'm not risking too much. So this is a really important one. The third thing I wish I knew when I started investing is the big can always get bigger. I don't know if this is the best way to put it, but I really skipped a lot of the big seven stocks early, like in, let's say, 2016, 2015. And I skipped them again many times because I would look at companies like Apple. I'm like, Apple is a $400 billion company. How much bigger can Apple really get? Then I look at Microsoft, $1 trillion company. How much bigger can Microsoft get? Microsoft's almost $4 trillion. Nvidia is $4.5 trillion. Now today we look at Amazon. Amazon is 2.3 trillion. And we ask ourselves, it's 2.3 trillion. How much bigger could it really get? And that really makes a lot of sense because normally, generally speaking, when a company gets bigger, the growth rate would decline and they can only get so big. But those big tech stocks, you could say this time is different, where they just keep on getting bigger. They keep on growing. They keep on delivering earnings growth. And I wish I knew that, but I didn't know that. So many times I owned Apple, I owned Google, I owned a lot of those stocks, 2016, 2017, and I used to sell them. I'm like, the company is 600 billion. How much bigger could it really get? So I'm going to move to the small caps, trading at 10 billion, 5 billion, 100 million, 600 million. And that was a mistake, So normally, generally speaking, in general, most companies, if they're too big, they can't really get too much bigger. But you have some exceptions, like I would say AVGO and Microsoft and Google, where I just don't see why they can't be bigger 5 to 10 years from now. I don't see how they're going to be smaller. It's really hard because they control a lot of things within our everyday lives. So it's really hard for them to get smaller. You just can't do it. You can't break them up. You can't do it. So I don't see how Amazon is not going to be a $5-6 trillion company 5 to 10 years from now. And maybe Apple could be, 5 or 6 trillion if the company puts it at 100p or something crazy, But this is how it is. So I would not skip a company because the market cap is too high. I would mainly just look at the thesis. If it's too high, I'm like, okay, they can likely get bigger. And I just wouldn't skip it because the market cap is too high. The fourth thing I wish I knew when I started investing is don't be scared from 52-week highs. So a lot of the times I talk about stocks and people tell me, oh, but it's trading at 52-week high. The stock is up a lot. I talked about Constellation Energy at $280. Now it's trading at $400. And people tell me, oh, but the stock is up so much. It's trading at 52-week high. That doesn't mean anything, guys. Yes, the stock went up, but what else has happened? Did earnings go up as well? Did the company is doing an acquisition, which they are, and it's going to boost earnings per share by a major way? Why is the stock going up? Is it just a multiple expansion? If that's the case, then yeah, maybe you should avoid it. But you should not skip a company because it's trading at 52-week highs. In fact, I posted a study, and this is a study that a portfolio buys stocks at 52-week highs, and another portfolio in the orange where they buy them at 52-week lows. And the one at 52-week high has massively outperformed the one that's buying them at 52-week low. And the reason for that is that most of the time, not all the time, but most of the time, companies make new highs because they're doing something right, and the market is rewarding them for that. And they make a new 52-week lows because they're doing something wrong. I'm not saying this is always the case. The market is not efficient. Meta was making new lows. Amazon was making new lows. They were not doing anything wrong. But generally speaking, this is how it works. And I bought many stocks at 52-week highs, like one stock called Mama. It was up 45% in 6 months. I bought the stock and now I'm up 400% in 2 years. I mean, because I saw the upside, I was not scared of losing money. I'm like, yeah, the stock is up, but the upside is high. So I'm going to start a small position. And if it goes lower, then I buy more and I'm going to hold it for the long term. So that's how I look at it. And I don't get shied away from stocks at 52-week high or at all-time high or stocks that are going up. It doesn't mean anything to me. I look at the fundamentals and I look at the upside from here. If the upside is still high, I'm gonna buy the stock. It's just like Ouster, where I talked about it with you guys, and I bought it at 21. Now it's at 35, and it was trading at $5 like 10 months ago. I don't care. I know the stock has a potential to 20x. So why would not I would not own it just because it's up, because I'm scared of losing money? All those things are things I used to do, but I no longer really fear them. And I think over time you kind of become the same way, where you look more at the fundamentals and the upside than just the chart. The last one that I would say, which I talked about before, is mainly learning growth investing. So when I started as a value investor, and I used to hate on a lot of growth investors and growth stocks and call them like speculators, gamblers. This is not fair. They just buy any crazy stock and they make money, and I buy those value stocks and they go down. And maybe some of you might feel the same way. But the truth is, when you're not investing in a growth related company, it's like you're betting against a tide, I would say. So a lot of them are disrupting those old traditional companies that you're buying, and the tide is with them. So they're growing their earnings, they're disrupting those companies, but the tide is against you, and you're trying to get something out of it. So it's a really big one. And in general, the market is structured to benefit the growth-related investments because of the high debts that we have, and the money supply keeps expanding, and cheap money is always going to be here. And all those things are very bullish for small caps. They're bullish for, you could say, growth companies and somewhat unprofitable companies. Now, I don't believe we should pay any price for a growth company. I did put up like a article. It's a free article, and I told you guys how I look for them: 3 to 5 times sales, 20% revenue, and there's a certain criteria. 1 year was in profitability, so I don't just buy any stock like Oklo or something crazy because it's a growth company. There's a way of doing it, and I learned it and I shared it many times. But I believe I would likely learn growth-related investing, and I would implement it within an overall strategy. It would not be my only strategy, and those are 5 things I wish I knew when I started investing. Hope you enjoyed it. Not financial advice. If you want to learn more about what I do and some videos on valuations and growth stocks and a lot of things, I share everything I do in my own group. This is the link if you're interested. But thank you again, and I'll talk to you in another video.